Okay, so in this lecture, we are going to cover several articles on mood, sentiment, and also weather. This lecture covers 4 articles. So we have the article published by Baker and Werkler in 2006 on Investor Sentiment Index, which is a classic piece on sentiment. And the second article is from Dehan et al., published in Journal of Accounting Research in 2017, which talks about how weather affects analyst earnings forecast. The third article is the article published by myself with my co-author Dang Latour in Journal of Financial Markets, talking about the pre-holiday investor mood and the announcement effects. The last paper, which is going to be the focus of my presentation, is a working paper written by myself with my former PhD student, Dylan Norris, as well as my former colleague at Florida State, Lin Sun. So in this article, we focus on how weather impacts institutional investors' mood and the earnings news market reactions. So I will talk about this article and maybe a little bit review of other articles when they are relevant. Weather has been used in the literature as a proxy for exogenous shift of investor mood, right? The classic articles such as Sanders 1993 has shown that New York City's weather impacts stock markets of the day, right? When it's a sunny day, stock markets tend to advance. When it's a cloudy day, stock market tend to decline. And this effect has been extended to over 26 cities around the world by looking at the weather condition of a country's leading stock exchange city by Hirschleifer Shumway in their 2003 article, which was the first article that posited that investor mood is the cause of the weather effect on stock markets. After that article in 2003, there's been a growing line of research that's studying the weather impact of market participants' behavior as well as its impact on asset pricing. Several main publications are listed here, such as the articles looking at retail investor trading behavior under the impact of weather, institutional investors' trading behavior, as well as the impact on stock returns under the influence of weather, how weather impact market makers' behavior, impact analyst behavior, which is the article I mentioned, as well as the forecast or economic outlook by small business owners, and whether your mortgage loan is approved or not by the loan officers. Okay, so those studies altogether show that weather condition has impact on market participant behavior, and in a lot of settings also have an impact on equilibrium asset pricing. So the article of ours is focused on the broad question, which is whether induced institutional investors' mood, can that mood influence how market incorporates public announcements? So we chose to look at the public announcement based on earnings because it's one of the most important firm announcements on the marketplace. And we focus on a stock's major institutional investors' location and see whether conditions in those locations would impact those institutional investors' behavior, which in turn translates into market pricing of firms' earnings announcements. So we look at major institutional investors. Our main test focused on the top 10 Although our robustness check also look at all institutional investors, we look at two measures of weather conditions based on the DeHaan et al. Model, a paper. The first measure is measure the cloud cover. So we look at the comparison of cloudy versus sunny weather. And the second measure is based on the pleasantness of the weather, which incorporates cloud, precipitation, as well as wind speed. So we compare the impact of pleasant versus unpleasant weather. And our Y variable, which is the variable interest, has two, right? So we have the first one is the size of earnings announcement premium, which I'm going to explain later, as well as the strength of the stock price response to earnings news. So for the first one is the average announcement return, which measures the earnings announcement premium. The second one is the impact on the news of the news on stock price, which is the sensitivity of the stock price in response to the news. So that's the two dependent variables we look at. Our weather data comes from the National Oceanic Atmosphere Administration, NOAA website, which hosted the data for over 35,000 weather stations worldwide with over 14,000 active. It records hourly measures of weather conditions, including a wide range of measures, such as wind speed, temperature, cloud cover, precipitation, and more. So we obtain the station day hour level data and aggregate across the day as well as across a specific area, all stations. Then we merge the weather data with the earnings announcement data from CompuStat and IBES during the period 1990 to 2016. So our observation after exclusion based on the standard procedure comes down to about 150,000 earnings announcement events. We have two measures of weather conditions. The first one is the cloud cover measure, which from the weather station data, at hourly basis, they record a number from 0 to 8. It's measured in units of octaves. Okay, so 0 means the least cloudy weather or the most sunny weather, and 8 indicates the most cloudy weather. So the higher the number, the more cloudy the weather condition is. So we aggregate the hourly measure from 6 a.m. to 6 p.m. for each station. Then we average daily measure across all stations within 50 kilometers to the institutional investors' headquarter, which is measured by the centroid of the zip code where the headquarter is. Okay, so but that's how our daily institutional level weather measure is obtained. Then we average the daily measure across the last 14 days as of the previous day relative to the earnings announcement to obtain the SKC measure. Then we have to deseasonalize the SKC measure according to the literature convention to take out the seasonal effect of the weather. So we're trying to capture essentially the unexpected weather relative to the season over the last 14 days before the earnings announcement. Okay, so the deseasonalization is taking the measure we have minus the mean of the same measure during the same calendar months over the entire sample period. We also tried to use the moving average mean. We got overall similar results. So that's our deseasonalized sky cover measure. And now we need to get the stock level measure, because this is the measure at the institutional investor measure level. Then we need to aggregate this measure across all institutions, all the top 10 institutions, using their holding as the weight in order to get the stock level measure. So this is following prior research by Gossman et al. And Dehan et al. To get the stock level measure of cloud cover. Similarly, we did constructed a unpleasant weather measure at the stock level. And the only difference is this measure captures the cloud cover, the rain, and the wind speed. So basically, we take the principal component of the 3 weather conditions before we do the other adjustments. Okay, again, the higher the number you see from unpleasant weather measure, the more unpleasant the weather is. So our dependent variable includes 2. One is our dependent variable includes 2 horizons. The first one is based on the short-term abnormal return earnings reaction, which is the cumulative abnormal returns for the 3-day periods, where day T0 is the announcement day. The second one is the post-earnings announcement drift measure, which captures the long-term reaction to earnings announcement. So it's a cumulative abnormal returns from day 3 to day 60. Okay, so we're looking at how market respond in the short term versus the relatively long term, and based on the weather conditions experienced by institutional investors in the prior 2 weeks. The mood hypothesis stipulates that the level of the car and the response of the car and PEAD to the news will be related to the weather conditions proxied by mood. But in contrast, the rational pricing hypothesis would predict that there's no correlation between the response of car and PEAD to earnings news related to the weather condition. Okay, so our first hypothesis is to predict that the higher average announcement return or announcement premium will be observed after following unpleasant or cloudy weather. This is because we hypothesize that the cloudy or unpleasant weather lower investors' expectation before the announcements and increase the perceived uncertainty. Therefore, investors would discount share prices more before the earnings announcement in order to account for the perceived high uncertainty caused by unpleasant weather. The second hypothesis or second prediction is that we expect to observe weaker short-term reaction and stronger long-term price drift following unpleasant weather. This hypothesis is based on the premise that unpleasant weather condition will induce greater inactivity among institutional investors. Therefore, they will exhibit less efficient information processing in the near term and delayed reaction to the news, which will be caught up in the long term. Okay, so that's our 2 predictions. We're going to predict and test whether unpleasant weather is positively related to earnings announcement returns on average. We're going to test whether unpleasant weather is associated with weaker short-term reaction and long-term, stronger long-term price drift. The first result is the test of the car, the short-term reaction on weather condition. So DUPW here is the deseasonalized unpleasant weather experienced by the institutional investors. And DSKC is the deseasonalized cloud cover measure experienced by institutional investors. As you can see here that we got consistent evidence with our two hypotheses. The first one is the positive coefficient of the unpleasant weather measure, which suggests that the more unpleasant the weather experienced by institutional investors prior to the earnings announcements, the higher the average announcement effect, the higher the earnings announcement premium. That's consistent with high uncertainty induced by high perceived uncertainty induced by unpleasant weather, which leads to more discount in price prior to announcement and higher earnings announcement premium. The second coefficient, which is the negative coefficient on the interaction term of the UE, which is the unexpected earnings, and the unpleasant weather measure, is also significant. Okay, so typically the coefficient on UE is positive. UE is the unexpected earnings, so the higher the measure, the more positive the news is. So return reaction should be positively related to UE. But when you see a negative coefficient on the interaction term, it suggests that unpleasant weather delayed or weakened the instant reaction of stock price to the news. Okay, so it's decreasing the positive reaction to positive news and also decreasing the negative reaction to negative news. So for the regressions based on the short-term CAR, we have consistent evidence with our hypothesis: higher earnings announcement premium and weaker short-term reaction. So this is the second test. In the second test, we also find consistent evidence with our mood-based hypothesis. We find a positive coefficient on the interaction term between UE and the unpleasant weather measure, suggesting that in the long term, there is a catch-up in the price reaction. So we see short-term delayed reaction. In the long term, that delayed reaction is realized. So the more positive the news, the unpleasant weather investors experienced before receiving the news, the stronger the long-term drift. So this is again consistent with the delayed reaction hypothesis due to inactivity induced by unpleasant weather. The third test is based on trading volume. If investors become inactive after experiencing unpleasant weather conditions, we should see declined trading volume surrounding the earnings announcement. Our tests support this hypothesis. The dependent variable here is the trading volume or turnover around the earnings announcement day. We find that more unpleasant weather is associated with declining trading volume or turnover, supporting the prediction that unpleasant weather induces inactivity and lower trading among institutional investors. We also provide additional evidence to pin down the channels through which institutional investors' weather condition exert an impact on equilibrium pricing, on how the market process earnings announcement information. So the first test is based on the location of the firm's headquarters. One can argue that maybe because maybe what we find is not due to institutional investors, but due to retail investors or investors in the location of the company's headquarters in general. So this has been shown in previous research that local investors have an impact on equilibrium asset pricing. Therefore, we include additional weather measure based on the headquarters city's weather stations. What we find is indeed local weather conditions have a similar impact on CAR and PEAD. So we have higher earnings announcement premium and delayed short-term reaction and stronger long-term reaction based on the local headquarter weather. However, after we include institutional investors' weather condition measure, the local weather measure are no longer significant. So this is an important result because it suggests that it is the institutional investors' weather conditions that matter for the short-term and long-term market reaction to news, not the headquarter weather conditions that matters. So next test, we look at which kind of institutional investors have a stronger impact on earnings announcement reaction. So we separate institutional investors based on their location, whether they are located in the center of financial center in New York City or outside of New York City. We find that, in fact, it is the non-New York City institutional investors who are making the impact on the earnings announcement effect, not in the institutional investors in New York City. So this results suggest that it may be those less sophisticated investors which are not located in the financial center like New York City, who are more impacted by the weather conditions they experienced, therefore exert an impact on equilibrium pricing. So to verify this hypothesis, we further define financial centers based on what we call hedge fund centers, which are considered to be sophisticated investors, and they will more likely to arbitrage away mispricing. They are less likely to be impacted by weather conditions and mood. So we identify the top 5 states year after year based on the number of hedge funds they have in that state. And then we look at the weather conditions experienced by institutional investors located in those hedge fund centers versus not. We find that, again, the effect we document is focused on non-hedge fund center institutional investors. This again suggests that it is likely to be the less sophisticated institutional investors who are driving the results we find. Our next test is to look at whether we can identify some channels for the institutional investors to make a greater impact. Okay. We find that the weather effect is stronger for stocks with higher institutional ownership. It's stronger during the first and last 5 trading days of the month when institutional investors are mostly likely to make trades. Also, it is stronger for announcement made towards the end of the week, such as Friday. All of the above evidence is consistent with the channel that institutional mood and the activity level exerting the impact of weather on stock prices. Okay, so we did additional robustness check, and then we have more in the current version of the paper. And those robustness checks all show that our results largely unimpacted through the selection of the sample or the construction of the measure. Taken together, our research was among the first to study how weather conditions experienced by major institutional investors would impact earnings announcement reactions. In the previous research, Dihang et al. Looked at New York City weather and showed that it has an impact on market reaction to earnings announcement, but they didn't look at weather across the nation, and they didn't look at weather that's impacting institutional investors, not necessarily the analysts, which are mostly located in New York. The previous research by Gosman shows weather influenced institutional investor buying and selling and general stock returns, but they have not looked at the impact on earnings announcement market reactions. So this is our contribution relative to those previous research. Taken together, our results show that weather influenced mood fluctuations even among institutional investors who are considered to be more sophisticated than retail investors. We find that unpleasant weather experienced by those institutional investors are associated with higher earnings announcement premium, weaker immediate reaction, and stronger post-earnings announcement drift. It looks like less sophisticated institutional investors are driving the weather effect. And even for institutional investors, weather could distort the information processing process to incorporate the news. Okay. So that's our article. Thank you for listening.